Hi, welcome back to Harvesting Income. You're watching the wealth creation series that we have started recently. This is the second video. First video was about top 5 obstacles to wealth creation. So if you've not watched that, please feel free to go back and watch that. And this is the second in the series. In this video, we're going to talk about the wealth matrix. This is a tool or a framework which is going to help you figure out how wealthy you are, where you stand, and how you can use that to grow further from there. So now we are going to try to answer these questions like how you can figure out where you are and how you can figure out how to use the wealth matrix to get ahead. That's going to be the whole agenda of this video. And whatever we are discussing here, it's not individual financial advice. So it's just for generic learning, but you can use that as a tool to further your plans or future financial, strategies. Okay, I'm going to give you a quick summary of what we are going to cover, and there's more to it beyond what is mentioned here. And first thing that we are going to talk about is framework thinking and what is framework thinking and why it is being used. And then I'm going to introduce you to the wealth matrix. That's the second part of it. And the third, we would move on to how you can use this wealth matrix. Is it just a reporting tool or is it a tool for growth? And then we will look at the 3 stages in the matrix and what it means for you. And finally, the most important and interesting part of it is how can you get out of this matrix? So that would be the you know important area because that would actually tell you how you can become financially free or when you can become financially free at what stage. So, and plus there are other areas which we are going to discuss to help you get some ideas about future financial strategies and future opportunities that you can use to enhance your wealth creation plans. So let's get started. First is framework thinking. So what is framework thinking? The word framework itself tells you that it's a kind of a way you organize your thinking. So it could be ideas or concept that you're trying to organize, or you're trying to break down a complex set of data or complex set of information or topics or ideas into a simple logical structure, or it could be a simple logical model. For example, you have SWOT analysis, SWOT, the strength, weakness, opportunities, and threats. And you have another example, which is the Porter's five forces. And you can also have other examples, like, for example, the 4 Ps in marketing or the Maslow's hierarchy of needs. So, depending on which area or which discipline you are, you have definitely seen multiple frameworks. Even if you are a normal person who has not gone into any kind of deeper study, you still know that you are using some tools or framework in everyday life. For example, you use your calendar and you use certain applications to track your progress. Some applications are used to track how many steps you walk, or some applications are used to track how much is your blood pressure and so on. So whatever kind of tool or application or framework you're using, that helps you achieve certain goals, or it helps you simplify complex topics into a simple usable model. So what's in it for us? In this one, we are going to talk about the wealth matrix, which simplifies a very complex topic which covers various people, various situations into a simple and understandable format. And from there, you can see how you can use it for your own personal growth and development. So let's get started. Now comes the interesting part, introduction to the wealth matrix. So before you jump in, I just want to explain a few things. Um, this matrix is basically a 3 by 3 matrix, like 3 rows and 3 columns. So you are starting from the bottom left. You see the number 2K here. That is the bottom left where you're starting. And you gradually move, like from 2K, you're moving to 4K, 8K, and from 8K to 16K, and so on until you reach 512K. Okay, basically, K represents $1,000. So if I'm saying 4K, it means $4,000. So there are two ways of using it. I'll just explain to you method one and method two. In method one, you're using your net worth as a measure to mark your position on the matrix. For example, if your net worth is $256,000. So you're on the top middle, 256K. You're in the top middle box. If your net worth is $16,000, you are in the second row, the middle row, in the 16K box. However, Just one point to keep in mind. Let's say your net worth is $20,000. So in that case, you're still in 16K because you have not reached the 32K mark yet. So use this like a milestone. Like let's say you have milestones on the highways, like it says that you reach the 10-kilometer mark and 100-kilometer mark. You, when you're in a particular box, you are either there or you're gone a little further from there. So it's a kind of a thing that marks your milestone. What are the milestone you have achieved, and where are you going towards next? What is the next milestone that you're trying to hit? So that's how you need to understand and read this. I hope that is simple to understand, not so complex. Method two, um, slightly different. Instead of the net worth, I am using investment value. In method one, I was using net worth, which means your total assets minus your total liabilities, what you own minus what you owe. But in the second one, we are using just your investment value so that you don't have to do the math every day to find out what your assets are, what your liabilities. It's going to be complex. So in the method two, you're just looking at your portfolio value. So you're just looking at one aspect of your financial, you know, life. You're not looking at everything, like right from your expenses to debts to assets to liabilities. If it's so complex and so overwhelming, it's better to use the method two. And in this video, in this session, we are going to talk about method two only. So in the method two, you are using the investment value as a measure to mark your position on the matrix. So let's say you have an account with Robinhood or any brokerage firm that you are opening your investment account. And in that account, you have, let's say, $50,000. Okay. So in that case, $50,000 is above 32K and below 64K. So you are in the 32K box right now, and you are heading towards the 64K milestone. So that is how you use the matrix. Okay. So I have already explained some of it. So the next slides are going. So the next slides are going to be pretty easier, self-explanatory. Okay. So I already explained to you the matrix starts at the bottom left and moves right. So if you are a little confused on how you have to move, like you are moving right, 4K, 4K, 8K, that's how you move. As your wealth and investment value moves up, you move 16K now, and then 32K, 64K, and then from 64 you move on to 128K, 56K, and 512K. And on the top, once you reach the 512K, you are actually moving closer to the $1 million mark. So once you reach the $1 million mark, it's technically you are like out of the matrix. We will discuss that in the next slide. I don't want to reveal the suspense now. So just keep waiting for that, and you know, it will definitely be a learning opportunity and a eye opener. And it was an eye opener for me because there is also a lot of information along with that would help you in the future. So as we know that it's K represents 1,000, like K represents $2,000. We all know that. I explained that. And your value or the investment value basically improves over time. Like sometimes it goes up, sometimes it goes down. So sometimes you come from 32K, you can move down to 16K, you can even move down. Like that can be a little scary. You made 32K and suddenly your portfolio value fell down from 32 to 28,000. So you're now moving one step backward. So that can be a challenge. So those are the things that you can keep track of. Like that helps you exactly know where you're going, exactly the place where you're falling and where you're falling apart. What are the things that are moving you backwards, and what are the things that are moving you forward. So that's exactly what we want to know. You know, and over time, your position moves based upon value. Like, and the majority of the population would fit into this matrix, except the millionaires and high net worth people. So typically, this would start from someone who is at a very lower middle class level, our middle class level, and it goes all the way to higher level up to the 512K mark. And even early millionaires or people who touch the $1 million mark, but they don't have enough assets or their value of their investment is low, could probably still fit in this matrix. Um, on the lower end, probably some people who are in debt or people who have not made any savings at all. We discussed in the previous video 5 obstacles. Like there are some people who don't have any savings at all. They are living paycheck to paycheck. So in that case, you are still not in the matrix. But that is a negative thing. Like you're not even started in the matrix. That's the problem. But on the other hand, you have people who have reached the $1 million mark and they're in the process of becoming multi-millionaires. They just become millionaires and they are financially free, independent. The millionaires are basically out of this matrix. So ultimately, that's where everybody wants to go. Like people who started with a humble beginning wants to reach that, and you want to get out of the matrix. I'll tell you the reason why and all that as we go ahead. Okay, now comes the stages. Like you understood the matrix, you understand how the values of your investment helps you move from one cell to the other, and you start moving up from row one to row three. But each row is actually a different stage of your financial future. That's something you need to keep in mind. Okay, there are 3 stages. I'll start from the bottom because the matrix starts from the bottom and then you go up, just like a ladder kind of situation. You start from stage one at the bottom, and then the stage two, and then you move to the stage three at the top. So that's how it works, and it moves from left to right as you move up in value. I'm just giving them some names just to make it more meaningful, so you can understand and relate to it. Like you don't want it. If I just say stage one, two, three, it's pretty boring and bland, and you don't understand what the significance of it. So I'm going to make it more interesting now. There are 3 stages. Stage one, obviously, you have a limited amount of investment value or limited amount of savings or investments to play with. Stage two, you have more. Probably you are in the median, American household income. You are actually coming up above the middle class slightly in stage two. Stage three, probably you're better off. You are already earning a six-figure salary. You're actually saving more. You already have a mortgage. You have a house. You probably have a car, and you're planning to buy a second one. You are at a little upwardly, mobile situation. Like you are moving up in your life, or probably you're growing up in your career or in your income. Or if you're a small business owner, you're moving up in your business. Regardless of your income, occupation, you're still in the matrix. I'll come to that, how these things can work differently for different types of people. So that's exactly what we will discuss as we move ahead. There's 3 stages. In the stage one, you're basically saving, nurturing. Like when you have an investment account of $2,000, $4,000, you're just saving a little bit, growing. Your investment is yielding probably a little bit of dividends, little bit of growth. Let's say your portfolio grew 10% last year. So you started with $4,000. Your portfolio went up to $4,400. So 10%, increase in the value. At the same time, you made some dividends. Let's say, you earned dividends, let's say around 3%. So basically that would be, $120 for a $4,000 portfolio. It's a small amount, $120. It's not going to move the needle. $120 for the whole year. Okay, so that's the small amount of value that you're dealing with. So it's not great, but at least you are making something, you are making a passive source of income. And at this stage, even though you did not hit the jackpot or you did not hit home runs, you're still growing, you're still doing well. And from 4,000, you gradually move into the $8,000 mark. And you start increasing your savings, your salary increases, you get a bonus, and you start doing this well for about a year. And you also, regularly keep adding more, like $100 a week to your investments. You add another 6,000, $7,000 over a period of time, your investment value will increase because you contributed and increased your capital. Plus, your capital also grew. Your capital also throws a lot of dividends every month, every period. And gradually, what happens is that capital and that investment value and dividends, everything put together grows to 16K. You move to stage two. Now, this happens probably over a year. for some people. For some people, it happens over a period of 6 months. As soon as they get a big break or a good job, suddenly it happens to them. Uh, it differs for every individual. You just do your own strategy. Don't compare with other people. So once you reach stage two, you have a better chance of increasing your savings. You can diversify into other funds, other stocks. You have more options to play with. In the stage one, you're just playing with a limited amount of money. You cannot take much of a risk. In stage one, you're more focused on not losing money. And stage two, you're trying to diversify and you're trying to improve or increase your efficiency. And you may also do something like kind of an automated savings and investment plan. There are some people who do that for savings. For example, after they receive every paycheck, they transfer 10% of that paycheck amount to their savings account. And some people do a little differently. They do the same savings part of it. Plus, they transfer another 10% of their paycheck into their investment account or brokerage account. So one 10% goes into the savings, the other 10% goes into the investments automatically every month. They don't have to do it. It's like an automated system or a plan. The bank website or your online website gives you the option to do the auto transfers, and that auto transfer or auto withdrawal takes that money out of your paycheck. So you pay yourself first. I've discussed about this in my previous video. You can watch that. This is a way to automate your investments and your financial future so that you don't spend it on the next, next big event or eating out or something else, because that 10% or 20% of your paycheck is already taken out. So you are left with the remaining 80%, and you have to manage your budget within that 80%. Hopefully, you got the message what I'm trying to say. And this is where you are like managing an orchard. Like earlier, you were a gardener, now you are managing an orchard. You are having a much bigger kind of a since sizable business that you have, like a small business owner. And when you come from 16K, 32K, 64K, all the way to the third level, third stage, 128K mark, now you are in the six-figure mark in terms of the investments. Now, whether your salary is five-figure or six-figure doesn't matter. Your investment value is now six-figure, which means you are actually on the cusp of a big transition. Like you are on the turning point where you can now do bigger deals. Now you can do bigger investments, and now you reach the stage where you still need to invest more, come up, financially successful in future. But even if you don't invest so much in your portfolio, the portfolio returns or dividends or income will actually be so sizable that just by reinvesting your dividends and moving things forward, you can still grow fast. Have you heard of this term called the snowball effect? And there's a book written by someone about the Warren Buffett's ideology, and they talk about this snowballing effect. When you invest in blue chip stocks and they throw in dividends, and you invest those dividends back into the same stocks, diversify, and so on and so forth, that snowball becomes bigger and bigger as you go ahead with reinvesting. Initially, the snowball is a very small size, marble sized. Gradually, it gathers some momentum and it becomes as big as a tennis ball. And now it's becoming decent size. And as it rolls and rolls further, it becomes as big as a football or a soccer ball. And when that snowball rolls down the mountain and keeps moving forward, it gathers a lot of momentum, a lot of speed. Now it's becoming threatening, like it can even destroy, a vehicle or, it can even hit a house, like, and damage a lot of things in the house. So it becomes bigger and bigger, and now it becomes bigger than a soccer ball and becomes so big that it's almost the size of an elephant. Like now it's going to be an avalanche or a big thing that's going to destroy whatever comes in its path. So that's the kind of compounding effect that you will feel over time. And in stage three, stage three, you're actually experiencing that compounding, and that compounding is actually moving you forward. Even if you don't invest further, you're moving forward. But that doesn't mean you're stopped, because you are going to do further more initiatives so that you can quickly come out of the matrix. So, uh, whether you're starting your career at a humble level in stage one, or whether you are just come from a poor background, or you just started with a small amount of savings, or you have a you know bad financial situation, you can come out of stage one ASAP if you do some systematic investing or savings plans. I can tell you one trick to come out of stage one ASAP. You know, even if you put like a $200 a month, sorry, $200 a week uh, into a savings account from your paycheck, every week, in about 50 weeks, by the end of the year, you have like how much? $10,000. So that is actually making you easily come out of stage one. You are not reached stage two yet, but still you're above 8K. You are almost at 10K. So 200 times, 50 weeks, you're out of that stage one. And you will have to do a little more effort to get into the 16K mark. That's it. It's not that easy. It's not that difficult. I mean, so anybody can do it. It's not that easy to like. You have to be disciplined enough, and I get that point. But it can be done pretty easily. Like if you don't do it in 1 year, probably you will do it in 1.5 years. Like it's just a matter of time. Like you have to start the process, and you should not stop that. Or if you want to increase your savings to 300 bucks a month, 400 bucks a month. Do whatever it takes. Come out of the stage one ASAP. Like, that's the key to your financial success. Like that is where you come out of the hamster wheel. Okay, so in the stage three, what you're trying to do is you're trying to act like a businessman. You have a much bigger portfolio. You use leverage. You use a lot of tools. Now you're now come out of this basic, uh, paycheck situation. You don't have any problem with savings and all that. Your financial situation is very good. And at each stage, you grow up incrementally. I'm going to give you another interesting finding now. How can you use the matrix now? That's the question that you have to ask yourself. Is it just a report or a tracker, or is it a tool for improvement or progress? It is actually both. Most of you might have answered it's a growth tool. That's true, but it is also a report tracker and tracking your performance. Uh, First part looks a little boring, but that is also important because you need to know where you're going right, where you're going wrong, and doing a analysis of what is happening in your life. It can be a bit boring because it's a post-mortem analysis. You don't want to go back to your past, and you don't want to go back and see what mistakes you've done. So it can be a little boring, little demotivating, but that can also give you a lesson for the future. So you know what to avoid in the future and how to minimize your risks. So, having learned all those lessons will put you on the progress to a better future. And that's how you will use this as a growth tool to see where you want to go. And when you see that the next milestone is pretty far and you need to work hard to reach there, you can put in those small steps. What small steps you will take every month, every week, and so on to reach that next milestone. So that helps you, get motivated to reach that target. So just like you have sales targets or you have your report targets or you have project deadlines in your work, similarly, you're going to fix those targets here. The matrix actually defines your target, and that target is very good. It helps you grow as a person. So that's why I use it as a growth. Now, what happens once you reach top, like getting out of the matrix? Okay, why getting out of the matrix? Like so far, we have said that the matrix is good. It helps you to grow. It's a wonderful tool. It helps you track performance, progress. Why you want to get out of the matrix is not that the matrix is not useful. You want to get on the top of the matrix first and then gradually get out of it for certain reasons. I'll tell you why. However, you cannot get out of the matrix without using it as a tool for tracking and then using it as a tool for progress. Without that, you're not going to get out of the matrix. The other way you can get out of the matrix is you can go bankrupt and you can go on the lower side, which is definitely not what you are trying to do. I mean, if you're thinking about that, then this video is not for you, fortunately. However, if you want to grow yourself and become financially secure, and achieve financial independence of freedom. And then come out of the matrix. That's exactly what getting out of the matrix is. So it's not nothing negative about the matrix itself, but you don't want to fall back downwards into the matrix. So you have to keep moving up in the matrix. That's the whole idea. Of course, you always have ups and downs in life, and you will have these ups and downs, or where you can move up or down in the matrix. There's nothing wrong with that, but you don't want to fall back on a continuous basis. So regardless of which cell you are, you have to go up. And once you reach stage three, also you need to still go up. Like it's not doesn't mean that once you reach a six figure, your life is secure. Today's cost of living and inflation, and you have uncertainties in the economy, and there's uncertainty with jobs. Now people are talking about whether artificial intelligence is going to take away the jobs. AI, artificial intelligence, machine learning, new tools, new techniques, whatnot. We don't know. And what about the economic situation, tariffs, and trade barriers, taxes, so many things that come in life that could break on any of these stages. If you are lucky enough to move to stage three and you gradually move up and reach the $1 million mark, only when you reach the $1 million mark you are out of the matrix technically. That's how I have defined it. Like if you're at 512K and you move up to let's say 800,000 or 900,000, you're still almost there, because if you lose a little bit here and there, if you lose 10% of your money, you can gradually come down, and then you could be back into the matrix. You don't want that to happen. So once you reach 1 million, you are completely out of the matrix. You are financially free, and then you can decide and prioritize things, and you don't have any targets to chase now. So you can prioritize on other areas of life, probably healthcare or spirituality, or you want to travel, or you want to do something else. Okay, so now using method two, assuming you have no other debts, if you are able to reach that stage three, you are on progress to financial freedom. And once you reach $1 million, you are financially free. Congratulations. If you really reach that stage, congratulations. And I'm happy for you and wish you all the best in the future. Bye. Sure. And the next one, I'm going to talk about that like what next after stage three. Some people ask, like, what do I do now? Like, just, I've reached my financial freedom. So it depends on your own goals and your own purpose in life. Now you're financially free, you can focus on other priorities. Like I said, could be charity, going on a holiday, or spirituality, or health matters, focus on family. Probably you spend a lot of time in your business. Now you want to focus on your family. It depends on your personal need. Like you have to sit with yourself or your family and then decide how you want to go further. That's one aspect of it. Second, once you reach the $1 million mark and you also focused on other priorities, now everything is okay. Now you want to, do the next venture or start the next matrix. You can go on with the next matrix, start with $2 million and follow the same process that I mentioned to you. Instead of starting with $2,000, now you're starting with $2 million, and this whole matrix starts again. Uh, However, I want to give you a warning here. You start with the net matrix only once you reach the 2 million mark. So between 1 to 2 million, I would say you have to take that break or pause. However, for some people, it may be different. For individual situations, we cannot just give one single model. But generally, I would say that if you reach that stage, take a break, take a pause, and then you decide when you want to do that. But my recommendation is like once you reach 2 million is when you will start the next matrix. That's my suggestion. The reason why I suggest a break or pause is to help you appreciate and enjoy the holistic aspects of life. Second reason can be like a transition, like you have some new interests or hobbies, or probably you're old, you had to retire, or probably you want to travel, or probably you wanted to spend time with kids or grandkids, or you wanted to spend more time with them rather than just trying to run around business and so on. Or you have like now you have new ventures of business, or passive income opportunities other than all this matrix stuff. You have probably your own investments, 401k or some safer investments, and you don't want to, go full on onto this. That's an option that you can take. Okay, now what if the value of my investment falls? Okay, in this case, you have to do a self analysis and see, uh, identify the reason for the erosion of value, and then check if it is due to the recent market downturn or you withdrawing funds from your investments. If you pick incorrect stocks, you have to, analyze the situation and then decide what you want to do. And if you have any problems, you need to find a solution to, those problems. And second, you can pause the investing and focus on solving the issues and then think about investing. Because if you have any financial problems, you don't have the leverage or the capacity to invest. And thirdly, plan to eliminate or minimize those issues in the future if you can, like as far as possible, or minimize it. Like you cannot eliminate, at least minimize it. And fourth is get back on track. Like this is a simple four-step formula. Like nothing great to explain here, but you need to identify the root cause of your problem and then start working on it. So that's how you're going to solve this issue if the investment value falls. Uh, okay, how long should I remain in each cell or stage? This is another question asked by some people when this model was introduced. Uh, there's no hard and fast rule, and this is a kind of a I would say dynamic kind of a system. We made it into a framework to simplify life situations or different dynamics that you see in life. But the simplified framework cannot simplify it for everyone. Like it assumes a certain things and then simplifies into a model. Now, using this model, now you need to find out beyond the model what are the problems that you're facing, and probably you need to find out what can be the solution. Like I said in the earlier stage, like ideally most people should be able to surpass stage one. Like I said, if you even do like a $200 per week savings, you can easily surpass stage one. Of course, there are some exceptions, like people earning minimum wages or people on low income jobs or seasonal jobs with a low income. It's a situation. But even in that case, I have given you some idea, like the $100 a week or $100 a week, do something so that you can move forward. There's a saying by someone that, if you cannot, um, if you cannot walk, at least move. If you cannot move, at least try to, shake yourself so that you can be active. You can be, you can use your mobility to get ahead. So the first thing is like you want to get out of the stage one, which is like a hamster wheel, ASAP. Like if you can do it in a month or 6 months, that's great. Get out of it as ASAP. And some people take it very lightly. Like I'm making a big amount of income. I'm earning $50,000 a year. Why should I worry about being in stage one? I'll still have my $4,000 portfolio, and I'm fine. Like, hey, the problem is it's not your salary that's we are talking about. You have not created your investment value or your own assets. Create your own assets so that your future is secure. Your salary or income is decided by your skills and your abilities and by the market conditions and by your employer and by your bosses and by your performance in the work and how it is being received or accepted by them. However, if you have your own business or own portfolio, you have a control on your financial future. If you don't understand this, I'm sorry, it's going to be difficult for you. If you understand this, probably you're going to make that extra efforts, make the second or third source of income. Second or third streams of income is going to help you in the future. I'm not telling you to quit your main occupation or job or business. That's not the case here. You need to have an additional streams of income for your future, for your own financial security and for your own financial growth. That's the quick message. Anyway, with that message, let's move to the next one. I already talked about different stages. I talked about this analogy of gardener, the orchard owner, and the plantation owner. Let me quickly explain that to you here, and then we'll go to the last part, which is very interesting. I'm going to put this on the cash flow quadrant of Robert Kiyosaki's book. where he explains the cash flow quadrant framework, and that will help you understand this much better. So at the stage one, you are just a gardener. You have a garden. On stage two, you have an orchard owner. Stage three, you have a plantation. You have the plantation owner, which is like large enterprise. So in the first stage, you are just a worker or a self-employed person. So you are still dependent on the wages. You still depend on the economy. Still depend on how many hours you work, how much of work you get, whether it's part time or full time, whether you get side gigs or whether you get full time contracts, whether you are self employed, you have your own team, or you have your own customers or contracts, or are you going to work for some company, or you're going to do both. You know, that's the kind of dynamics you see in the gardeners. But mostly gardener level, you are still working for someone, you're still depending on your paycheck or the employment source of income. And when you have an orchard, when you become a bigger gardener and you have your own small garden, a nursery, orchard, and that kind of setup, and you also have your own produce of fruits, or you have your own produce of, let's say, vegetables or some other kinds of agricultural produce, you are now a small business owner, and that business is giving you sizable income. It's not just like contractor, like you have your own setup business. People come to you and they purchase your products, or they purchase your services. So in that case, you are better off. Like once you reach the orchard stage, you are one level up compared to many people. Like you are ahead in life. Like you are actually crossing the median level of income, and you are financially secure. And when you're in a orchard situation, you could be a business owner, but at the same time, you could also have some side gigs or extra work that you get as a contractor. But mostly you're focused on the business income, not like a worker. You're trying to spend a lot of hours and get paid low. You have come out of that level now. Now, moving to the next one, which is very, very beautiful and interesting, that all of us want to reach. You want to become the owner of a plantation. You have multiple orchards in different locations. So even if one of them doesn't perform well, you are still doing well. You are diversified. You are a large enterprise. You have all the tractors and equipment and delivery vans and trucks and so on. You are doing business across the province, across the state, across different locations. That's a true mark of an enterprise business. That's where you want to reach once you reach stage three. That's where you are. Like depending on how big or small the business is. Like in this case, most probably you have already incorporated the business. You have formal business. You have a formal team, a formal set of employees, and each employee has a different role, and your role is defined, and you don't have to go and do the you know cutting the weeds and doing the regular day-to-day grind of the mill stuff. Like you don't have to do all the grunt work anymore. You have given the responsibility to your managers, to your employees, to do the job for you. Your job is to track your business and see how it's performing, give the orders, give the instructions, and let them do it. That's perfect world, scenario. That's where you want to reach, right? So that takes some time, like that takes a lot of experience. So you need to build that experience. You need to build that body of work for yourself. And last but not the least, I'm going to just conclude with this slide. And here we talk about the cash flow quadrant, like Robert Kiyosaki's cash flow quadrant. If you have not read that book, you can go Google online and find out what is the cash flow quadrant. It basically has four sections. It's a two by two matrix. You have E on the left top, you have E employee. On the left, the bottom, you have S self-employed. On the right top, you have B business owner, and on the right bottom, you have I the investor. So I've just plotted the gardener, orchard owner, and the plantation owner in this chart. Like if you're a gardener or an employee, like you are in the stage one, you are just an employee or you're sometimes self-employed, but you're still not gone to next stage. If you're an orchard owner, probably you are self-employed and you are a business owner too. In some rare cases, you could also be an investor. So orchard owner is predominantly in the business owner and self-employed boxes. And if you're a plantation owner, you're on the business side of things. You are a business owner and you're also an investor, which means you also invest in businesses. So this investor that we are talking about here is not investing in stocks or bonds. That type of investment is not what we are talking about. We are talking about people who invest in others' business and still make money out of it passively. So you want to come out of the left boxes onto the right to get ahead in life. If not, you're going to be spinning around, and you're going to be in the hamster wheel, and you're going to do the same run of the mill stuff, and you're going to get paid the same salary, same increments, and you will be a victim of the circumstances, and you will have the issue of not being able to meet your expenses. Inflation will eat into your returns, and so on and so forth. Once you move to the right side of the matrix, you have the business, you have a control. You have a lot of risks, but you also have a lot of control, and you have ability to use your business steer you ahead in life. So I hope this provided you a lot of food for thought, and also a framework called the wealth matrix to improve your future. And I hope you'll use that and leverage the power of the wealth matrix for success. And if you like what you're watching, please feel free to subscribe to the channel and share it with your friends and network. And if you have any questions, please feel free to drop your comments, or if you have any feedback or any suggestions, drop in your comments below. And I look forward to hearing from you. Happy investing. Thank you. Have a great day.